present situations, many of the transactions has done in credit basis only. Okay, credit basis means at the time of transaction there is no cash involvement. Okay, that is called as credit transactions. Okay, so that is the reason this chapter bills of exchange can be introduced the one. Okay, this is the bills of exchange. Okay, there is a, for example, seller and a buyer. There is a two parties. Okay, seller and buyer. Seller, maximum he has to be increase the sales, try to increase the sales. But buyer also has an interested to purchase the goods. Purchase the goods for resale, but at that time, buyer doesn't have a sufficient amount to purchase of that is a particular goods. In that situation, seller has a given credit to the buyer, and without given at the time of the time of transaction there is no cash involvement, means without receiving the cash, the seller has sent the goods to the buyer. That is only the credit transaction. So buyer, when will he pay, means it is maybe he will take the 3 months, 1 month, 2 months or 3 months so and so time period. He has asked to somewhat time payment to somewhat credit period. That is a buyer has taken the credit period. But seller has an urgently required the amount. Urgently required the amount to payment of his creditors. His creditors are for payment of any salaries and so nominal expenses. So that is the reason. So bills of exchange chapter can be raised. In this situation, seller has sent the goods to the buyer. Instead of payment of the cash at the time of transaction, he can accepted one bill. He can accept one bill. He can accept it and send to seller. So finally the bill for seller point of it is bills receivable, and for buyer point of it's bills payable. For seller point of it is bills receivable. He can receive the bill, no? So it is point of it is bills receivable, and buyer point of it is bills payable. So the seller, what he done, whatever the bill has a seller, this is the bill. Simply he can use this type of, that is he can discounted in the bank. Means, for example, 10,000 worth of the bill. That is a bill amount. This 10,000 worth of the bill amount is if you discounted in the bank will, example, it's given 9,500 to you. And 500 is a discount amount. Or otherwise he can endorsed to his creditor. Whose creditor? The seller creditor. So seller also purchased some of the goods from somewhat creditors. Hence that is a seller, whatever has a bills receivable, that is a bills received from his buyer, his customer, then that is a bill simply he endorsed to his creditor. That is the second point. And another one, he can retained with him. The time of that is a bill due date. He can retain with him and అతని దగ్గరనే ఉంచుకుంటాడు. Next another point, bill sent to bank for collection. Okay, these are only the 4 points. Okay, this is like this type. Okay, so the seller utilized the bill, so that that is if any needed amount, okay, urgency. So he can bill sent to bank. He can he went to bank, and that is a bill discounted in the bank. Okay, discounted in the bank, and he received 9,500 at that time. Okay, that is a 500 discount. Finally, whatever the buyer has to payment to the bank, that is a 10,000 rupees. Okay, that at the time of bill due date. Okay, the seller doesn't have any entries. The buyer only directly go to the bank, and bank receives, that is a 10,000 rupees. Okay, or otherwise the seller what can he done? Endorse to his creditor. Okay, so he also somewhat the seller, okay, for example, he is A and a B. Okay, A and B. This A person has a any payments due. Okay, he can, that is a bill, the whatever the received bills receivable he has, that is a bill is simply sent to his creditors. Okay, and retained with him, okay, up to the due date of the bill. Okay, due date of the bill means, okay, that is a maturity of the bill. Okay, maturity of the bill date. Okay, on that maturity of the bill date, okay, he that is a bills receivable, he can keep with him only, that is a retained with him. And final one, bill sent to bank for collection, means before that, few days before the due date of the bill. Okay, few days before of the due date of the bill, simply he can send to that is a bill for collection to the bank. Okay, bank bill sent to bank. Okay, bill sent to bank for collection. Okay, that is also one of the entry. Okay, these are only the 4 situations he can utilize the bill. Okay, most of the one he's benefited, that's before due date. Okay, he can benefited like this. Okay, this is at the time of maturity date. Before maturity date, these are only the situation, that is a bill discounted in the bank and endorsed to his creditor. Okay, whatever he can fulfill, it's economical. Okay, that is only the bills receivable in the point of A. Okay, so in this one, goods can be sold or brought for cash or on credit. When goods are sold, brought for cash, or payment is received immediately. Okay, if it is a cash transaction, cash received immediately. On the other hand, when the goods are sold, bought on credit, the payment is deferred to a future date. If it is a credit transaction, the payment is decided in the future. Okay, in such a situation, normally the firm relies on the party to make the payment on the due date, but in some cases, to avoid any possibility of the delay or default, an instrument of credit is used through which the buyer assures the seller that the payment shall be made according to the agreed conditions. Okay, that is as per that conditions, okay, bills can be written. As per Indian Negotiable Instruments Act 1881, there is one of the definition, that is, the definition is given by Negotiable Instruments Act 1881. Okay, Act 1881. The definition is given as per section 5 in this act. A bill of exchange is an instrument in writing containing an unconditional order without any conditions, signed by the maker, directing a certain person to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. That is only the bills of exchange definition. In this, if you clearly see, that is a bill of exchange is an instrument. It's one of the document it is a legal one. In writing, it should be in writing, containing an unconditional order signed by the maker, and without any conditions, he should be in that bills somewhat amount should be paid at that time, on that somewhat date. Okay, unconditional order signed by the maker directing a certain person to pay. Okay, here in this bill we should be clearly mentioned who has to be paid. Okay, that is only the directing a certain person to pay a certain sum of money only to or to the order of a certain person. Only to or to the order of a certain person. The particular existing person, okay, should be order or to the bearer of the instrument. Bearer of the instrument, who has the, okay, bearer, okay, bearer of the instrument. That is only the section 5. It tells about the, okay, definition of Negotiable Instruments Act. Finally, the features of bills of exchange. It must be in writing, it must be in order to pay, okay, and somewhat amount has to be paid, amount only, it should be, that is whatever it has to be paid, that is only in amount one. The order must be unconditional, without any conditions, and it must be signed by the maker, that is a drawer, okay, should be signed by the drawer. The order must be directed to a certain person, okay, must be and a particular person who has to be paid, that is a bill on whom he has written, that is only the one. The order must be for the payment of money only, and the amount payable must be a certain, the exact amount how much he has to be paid. For example, 9,000 to 10,000, he may be paid on that day 9,000 to 10,000, not like that, either it is 9,000 or 10,000, that is the amount should be mentioned clearly here. And the amount must be payable to a certain person named in the instrument, or to the his order, or to the bearer of the instrument. Okay, we should be mentioned clearly, that is a drawer, who was the drawer and who is the drawee names, and it specifies the date by which the amount should be paid. Okay, on which day he has to be paid the amount, that should be clearly mentioned in the bill. Okay, and last point, it must be accepted by the drawer to make it a legal document. Okay, drawer should be accepted, okay, on that bill, to make it a legal document.